This foreign stock really caught my attention. I mean, you're practically buying $1 for 60 cents. Hey guys, how's it going? My name is Charlie Marr, and like I said, in today's video, we're gonna go over a foreign stock. And in fact, it's a stock that's based off in Japan. And it's screaming buy. It's super undervalued. It's a great stock, and we're gonna go over the numbers. So let's go ahead and get right into it. Like I said, this stock is a Japanese stock, so everything we're about to look at, all the numbers, they're all going to be under the currency yen. So it's the Japanese dollar pretty much. Yeah, but again, it doesn't change anything. All the ratios, your return on your investments, and all that is going to be the same. However, I will say that because it is a foreign stock, you're not going to find this stock in one of your regular brokers like Robinhood, or maybe not even TD Ameritrade or the broker you use. You might have to use a more advanced broker that has foreign markets, kind of like Interactive Brokers. Interactive Brokers definitely has this stock. I don't believe TD Ameritrade does. I know for a fact Robinhood and like your bank and all those won't have this ticker. Again, this is a whole different exchange in the Japan market. Anyways, let's go ahead and start getting right into the numbers. This is buying $1 for 60 cents. I may or may not have made this video before and I messed up, so I'm remaking it. If you watched the last one, you know what happened. Let's go ahead and move on. Anyways, so let's go ahead and get to the stock here. So the ticker is, the company's called IO Data Device, but the code is 6916. So we can go ahead and type that in. I will be using for this video this website called Ticker, T-I-K-R. This is my second time actually using them. I'm not sponsored or anything like that, but I'm trying to get used to it. And it's pretty cool. I mean, it has everything that I need. It gives me my numbers right away. And I like how it has all the foreign stocks on here. So you won't really find this on an app like Seeking Alpha or a website like Seeking Alpha or other like, what's it called? Market providers, I guess, whatever you want to call them, terminals. Anyways, so let's go ahead and get right into it. So like I said, the company is called IO Data Device. The code is 6916. This is everything we need. It's going to be under yen, like I said, but that's not going to change the fact that you can still make a lot of money in the ratios and the return on your investment. It's all the same. So here, what is the company? Together with its subsidiaries, it engages in manufactures and the sale of digital home appliances. So long story short, I'm not going to read it all, but it sells a bunch of like electronic devices and like SD cards and like monitors and like just a bunch of different electronic devices. So that's it. It's just a lot of devices, which I guess you can tell by the name, IO Data Device. Let's go ahead and get right into the numbers. So when we go into ticker, we're going to scroll down and go into financials. So we're going to click financials. And right now we can tell, actually, before we do this, let's look at the stock's market cap and the current price. And let's write all that down so we can compare it to our valuation. So the company is called IO, but it's actually under 6916. That's the ticker. Its current price is going for the yen 784. That's my dog dying in the background. 784. And the current market cap, I believe it's going for 1006 billion. Now let's remove that B for billion. We don't need that. So for 1006, let me just double check. Move my thing. Market cap, yeah. So for 10.06 billion, and the current share price is 784. So that's where we stand right now. And let me just make sure I wrote all that correctly, 784 and 1006. Yeah. So these are the numbers we're trying to beat. This is the market cap, and this is the valuation and the stock per share that we're trying to beat. If our valuation comes out a lot higher than this, then this stock is currently undervalued. Let's go ahead and get right into the numbers. So like I said, we're going to go to the financials. And we're going to scroll down. You can see here annual financials in millions of Japanese yen. So everything we're about to look at is in the yen. And just in case you're on a different one, make sure you're on the annual one. We don't care about the quarterly or the semi-annual. We're going to focus on the annual one for this. And as usual, when you go into any financials, you're going to see three statements. You're going to see the cash flow statement, the balance sheet, and the income statement. We're going to spend the most time in the balance sheet. So let's go ahead and go into the balance sheet. And this is the column we're going to be spending the time in. It's the last reported. We're not going to do this one or the one before. We're doing this one, 2021. So let's go ahead and look at the numbers. Okay, so cash and cash equivalents, and in the total cash and short-term investments. This is cash. This is the most liquid you can get, as I always say. There is nothing to do with these numbers here. This is just cash. So we're going to leave that as it is. If we go forward, we can see that they do have account receivables. And we can actually see that they have the total here already for us. So they have 9.5 billion in account receivables, and that's yen. So what we're actually going to do is we're going to deduct 25% of this. We're going to grab all the discounts, add them all up, and at the very end, we're going to subtract it from the company's current value that it has, and we're going to come up with the possible liquidation value. So like I said, for this one, we're going to do 0.25. So let's go ahead and do that right now. Let's open the calculator, and let's type that number in. So account total receivables, they have 9,529 billion. Make sure you do the billion. Make sure you can do the decimals, but I'm going to do the whole thing for the sake of the video. So 9,529 billion. We're going to multiply that by 0.25. So we're going to remove around 2.32 billion yen. So let's go ahead and write that down. And actually, I'm going to take a screenshot of this, a picture with my phone, so I can just write it down a lot faster, just looking at it from my phone, because it's going to go away when I start typing. So let's move myself out to the side. The very first amount we're going to be removing is 2,382,250 yen. Also, I might put the dollar sign sometimes. I'm just going to put the dollar sign, but just know that we're actually doing yen, okay? It's going to be hard for me to get used to doing the yen. Anyways, I'm just going to do the dollar sign. Okay, so let's go on to the next one. So what else do they have? They have inventory. This is what I forgot to do last time. It went through me. I'm so used to looking at these other. Anyways, so they have 15,457 million. So let's go ahead and write that down. And again, this is devices. So we're just going to go with a very standard 50% discount. So if you were to liquidate this company, all their monitors and all their devices and SD cards, everything that they have, you're not going to sell it for the full value. You know, you're going to be like, what's it called, when a store goes out of business and they just start selling everything at a discount. And I think 50% is more than fair. Plus, there's more that we're doing it to it that'll give us a margin of safety. So 50% off of inventory. And let's go ahead and see what that gives us. Inventory stands, here it is, inventory. It stands at 15,457. 15,457. And that's billion. So let's make sure we're at billion. Again, all we have to do here is divide by 2. This is how much we're going to be deducting, 7.7 billion yen. I'm going to take a screenshot of that so I can write it down. And let's go put it down on our pad. So we're going to be deducting 7,728,500,000 yen. Like I said, I'm going to be doing dollar, but we know it's, I hope I remember that's a 2. That it's actually yen. So that's inventory. What else do we have here? Okay, we have, let's go ahead and scroll down and see what else we have. We have all these tax stuff and other current assets. There's nothing to mess with there. All that is good as is. You can go a little deeper and look into current assets, but like I said, this is just a very small amount. It's not really going to make a big difference at the end, and you'll see why later on. Let's see what else we have. There's nothing there. We have a little bit in net property and plant equipment, which is fine. We'll leave that as is. Other intangibles. So we have other intangibles. Let's go ahead and remove that. I see that there's no goodwill. I'm trying to see if there's anything else we need to deduct, but this company is actually quite simple. So, and as far as other intangibles, for this company, we are going to remove it 100%. Of course, you can go in deeper and see what those intangibles are because in today's world, we've evolved to where intangibles can actually be sold for something if you liquidate a company. But in this case, we're going to remove them on. Like I said, it's not that big of a difference. Anyways, we're removing it. we're doing 100% discount off of this. So that is 806 million. Let's go ahead and put that in. And then at the end, I'll check if I missed anything. I might have missed something. So we're going to remove 806 million yen. Let me double check in case I'm missing anything else. We deducted account receivables. We deducted inventory already. We're leaving all these as is. We don't have anything else on here to deduct. Other intangibles, we already removed that. We did 100% off of that. And that's it. That's total assets. Total assets are 42 billion yen. Everything else underneath that is liabilities. There's nothing to mess with there. So now what we're going to do is we're going to add all these discounted items, and we're going to subtract that from the total of the company. So let's go ahead and do that now. Let's go back here. Let's scroll down at that column. So what we need to do is we're going to grab all the assets, all the positive assets, and remove all their liabilities. Like we're going to pay all their liabilities with their assets. And so yeah, that's what you're doing. But we don't have to do the math because this already does it for us, like I tell you guys all the time. And you can scroll all the way down. Here's their total assets. If we subtract that by their total liabilities, you get their total equity. Of course, we're not going to stick to total equity as shareholders. We're actually going to do total common equity. In this case, it is a little bit different, so we will stick to total common equity, which is 28, and we can actually write that down here already. Well, actually, let me take a screenshot of this. Let me put my mouse on it so I can remember. So it's this one right here. And let's go back to our numbers. This is 28,866 million. So that's what the total equity of the company stands as is. That's just those numbers, their books, their stuff. Now we're going to deduct the numbers that we're deducting. So if we deduct that, we're removing, I guess we need to add all these. Let's go ahead and do that now. Let's see what we come up with. That's 2,382,000,000 with 250,000 yen. We're going to add that by 7,728,000,000 with 500,000. And then we're going to add those intangibles. So that's plus 806 million. So we're going to be deducting about $10.11 million from the company. Let's go ahead and write that down. Let's go ahead and subtract that now. I'm going to take a screenshot as usual, just so I can do this easier. So we're going to be removing $10 billion, 916 million with 750,000. That's what we're going to be doing. And then we're going to come out with our liquidation value right here. Let's go ahead and do the math and see what we get. I wish I can copy this. I think I can, but oh well. 28,866. This is billion minus 10,916, 750,000. That means that the liquidation value of this company should be around 18 billion. I was going to, should we round it to 18 billion? Let's go ahead and round it to 18 billion. It's fine. It's not too far out. Let's just round it to 18 billion. It'll do our math. It'll be our math will be a lot easier. Plus everything you'll see later on will make sense. So liquidation value is around $18 billion, 18 billion yen. There you have it. That is our liquidation value. Usually I round down, but it's just too close to 18 billion. Plus we'll use a margin of safety, so it'll cover us. So that's our number right there. 18 billion yen is where this company should be. Where is the company trading at right now? Look at its current market cap. It's currently at 10 billion. So it is currently undervalued. Okay? So far that's a check. Now let's convert this to per share. Okay, so let's go ahead and do that. All we have to do is grab that number, which is 18 billion, and we're going to divide that by all their outstanding shares. So let's go back to ticker. If we scroll all the way down, you can usually find this in the summary, by the way. You can sometimes find it in the income statement, very rarely. Most times you'll find it under the balance sheet or just the summary of the company. If you scroll all the way down on the balance sheet, you almost always see it there. Here it is, total shares outstanding on filing date. They have 12.84 million. So let's go ahead and do that. Divided by 12.84 million. That means that this stock should be trading, or its liquidation value is 1,401 yen. Let's just round it down to 1,400. Make our math a little bit easier. There you have it. That's where the stock should be trading at when it's currently going for 784. That's almost $1 for 50 cents. I think that's like $1 for 60 cents. That's pretty good. That is undervalued. I mean, look at everything we did. We talk about this in every video that when I do this. We grabbed all their assets, we discounted a lot of their items and a lot of their positives, and then we subtracted and we paid back all their debt, all their liabilities, and we came out with $18 billion. That's the liquidation value. It should be around 18 billion. We went ahead and converted that to per share. This stock should be trading around 1,400 per share or higher. Remember, companies sometimes become overvalued. That's the great thing about the liquidation value. The stock doesn't have to just run from 784 to 1,400. Sometimes it becomes overvalued, so it can go up to 1,500 or more. Anyways, so that's the number so far. I'm going to take a screenshot just in case I need to come back to this later and make sure I remember all those numbers. That's a buy. Now, what else do we need to look at? Let's go ahead and look at, before we get into that, now, what's the buy price? Because now we know where it should be, what's the liquidation value, but where should we buy it? We need a margin of safety. We're going to give it a 50% margin of safety because our goal is to try and buy $1 for 50 cents. So all we have to do is divide that by 2. So, I mean, obviously it's 700, or something like that, 750, I don't know, 700. Divided by 2, it's $700. So this stock is a buy when it's at or under $700 per share. It's really close. It's currently at 784. To me, this stock is a buy right now, and I will share why. Not just because it's too close. I mean, it's not that far off. It's not like it's at 900 or 1,000. I mean, it's really close, but for another reason, which I'll explain later. So you can wait for it to go below 700. There's nothing wrong with it. I mean, sometimes, just like this stock, I'll have a lot of these in my watch list, and the moment one of them crosses below that buy price, I mean, it's a buy price. I just have to kind of come back and check everything else. Okay, let's go and look at some more stuff. So it's currently at 784, and the liquidation value is 1,400, and it's a buy under 700. So those are the current numbers, right? Let's go ahead and check out what else. So what do we have so far? Is the stock undervalued? It is undervalued. Is the stock trading below or at a buy price or close to it? Yes. So I'm going to give it a yes. So it passes. Now, is the company a growing or a dying company? What's something that I always tell you guys? You should know when I'm drawing this out what it means. If the company is a growing company, which means overall it's growing in value, that means that time is your friend during these times. On the other hand, if the value of this company is slowly decreasing, the longer you hold a company like this, the harder it is. So time's actually your enemy during these times. So you want to be more careful with companies like this. So let's check what kind it is. Is this a growing company or is this a dying company? And all we have to do is look at the equity. We can look at all their numbers, their assets. We can look at everything to make sure where it's headed. But in overall, you kind of want to see their equity. So we go back to their balance sheets. Here's total receivables. Have their total receivables been increasing? They're kind of all over the place. I mean, they started at 8 billion and then went to 9 billion, 10 billion, but they've been higher in the middle. Their total assets, that's the important thing here. From 29 billion to 34 billion to 39 billion to 40 billion, 41 and 42. Their assets have been growing. Now, of course, their total liabilities are probably also growing, but are they overcoming their assets? Like, are they doing more than they should? We can look at the total equity here. In this case, we're actually going to stick to total common equity. They went from 20 billion to 22 billion to 25 billion to 26 to 28.1 to 28.8. This company is a growing company. Their total common equity over time is growing. What does that tell us? That tells us that if we were to do the math, most likely, what it means is that our liquidation value of 1,400 over time, every year is most likely going to be increasing. Does that make sense? So maybe by year 2, this is just a guess, maybe it ends up being 1,500, or maybe it does grow all the way to 1,600, but overall it's growing. We saw it in their total equities, and it's not like, what I'm trying to tell you is that it's not like it's all over the place. So their total equity isn't like up and down, and unpredictable. This is predictable. I mean, it's growing it's growing consistently, it hasn't had a down year. It's just growing overall. It's doing well. So that is another check. That's a good thing. We love that. It's a growing company. So that's why I don't mind buying $1 for 60 cents. Because usually I like to buy $1 for 50. Usually I like to buy $1 for 50 cents, right? But in this case, we might be buying like $1 for, maybe it's like 55 cents. I think it's actually 60 cents. But it's fine. I'm willing to pay those extra 10 cents. Why? Because the longer I hold this stock, or over time, I know that the liquidation value is going to be going up over time. What's another thing we want to check? So it's a growing company, it's undervalued, and it's around the buy price. Let's look at their their outstanding shares. Are they diluting shareholders? Are they screwing you over? Are they decreasing your small ownership? Let's go ahead and find that out. Again, you can see this. Usually, you can always find this. I already talked about that in the balance sheet. If we go down, you can see that here. Total shares outstanding. They had 13 billion in 2018, 13.23 billion, 13.23, 12.84. I'm going to refresh that just in case these two numbers aren't popping out, but I'm pretty sure that's fine. Oh, I don't think this is in the right spot. Balance sheet. Scroll all the way down. Okay, yeah, so that's fine. So 13.63, 13.23, the same, and now 12.84. It's decreasing. You know what that's telling me? It means that they're buying back shares. And you know why they're probably buying back shares? Because they know their company's undervalued and growing over time. So they're buying back shares. This is the best case scenario. We love this. Something you want to avoid is when it's the opposite, when it's increasing. You want to be careful with those. In this case, it's actually decreasing. And it's not just flat. It's not just 13 billion, 13 billion, 13 billion, 13 billion, where they're just not doing anything. They're buying back shares. That means it's also going to reflect on the stock's price. It's going to go up. That is another check. I mean, we have just check over check over check here. I love this type of companies. It's a growing company. It's undervalued. You have a margin of safety. They're buying back shares. I mean, what else do you want? It's a great company. I love it. I like this. Let's go ahead and look at this real quick. We're practically done with this company. So let's put this line where the liquidation value is at, which was 1,400. There it is. And let's see where it's currently trading at. Actually, I can just duplicate this. Clone. It's currently going for 783. Did it change? 784, 783. There you go. Look at this. It has a nice gap to fill. It looks like it's actually hit that in the past, even though that's other years. That's crazy because, okay, so this is a cool thing. Other years, we've known the equity is lower. I mean, we saw that. We saw it with our own eyes. I mean, the equity was much lower. So it's cool knowing that it hit that. So in the future, when this company is hitting those highs again, I mean, we'll probably be breaking new highs since we have in 2017. So I love this. And this company overall, I mean, is just growing in general. So it's a great little company to hold. I mean, this is a nice little company to jump into. I like this. Let's go ahead and see real quick. Let me see if I can grab this and move it out to the other side here. Let's see what the growth is. So what was it? Right around that. If it goes back to 1,400, you're looking at about a 78% return on your investment. Let's just make sure here. 784. to 1,400. 78, a little higher. 78% ROI. That is pretty good in my book. And then again, remember, this is a growing company. So over time, the longer you hold one like this, the better it is. I love this company. It looks like the company just kind of became detached from the growth that it was having. I mean, I bet this company right before 2020 was probably going to start hitting new highs and kind of have. So what you're seeing here was probably going to be up here, but with COVID and with everything that happened, I mean, it just kind of turned around. I mean, and this is the opportunity we have. It's your job. It's your call if you want to wait for 700. I mean, I personally don't really care about that stuff. I keep it simple. I buy when the value is there and I sell when it's not. For me, it's there, so I'm all for it. And again, it's growing. I will make that exception because it's growing. If it was a dying company, heck, I'd better be under $1 for 50 cents or even lower, $1 for 40 cents. Give me an even bigger margin of safety. So yeah, that's pretty much it on this end. I'm trying to think if there's anything else I need to talk about. I have like a couple 4 or 5 minutes left before we get the 30-minute mark. But that's everything. Oh, I guess. Do they have income? Let's go ahead and check that out. We can add another check. Is a company making money? You know, I always tell you guys something to be careful with is, let's just say you come up with a liquidation value of $50 million, right? Or the market cap, but the company's losing $100 million per year. I mean, this company is going bankrupt. Does that make sense? Or if it's 50 million and they're losing $25 million per year, and you can probably see this in their equity, you know that this company, like in pretty much 2 years, it's gone. In the first year, it's going to end up it's going to go down 25 million. So it's going to be at 25 million. By the second year, it's going to lose those 25 million. It's going to go to zero. even if this thing slows down, it's falling too dramatically. Anyways, that part doesn't really matter there. But what I did want to talk about again is that company profitable? Are they making money? You know, that's a plus. It's a great thing to see that. So let's go to their income statement, cash flow statements. Net income. They went from 1.3 billion to 2.3 billion to 2.9 billion to 2.1 billion to 2.5 to 1.8 billion. So they have been profitable every single year. It's not a consistent growth. It's not like that in any way, but they are making money. I like that. You know, it makes me feel a little bit safer. On average, I don't know what the average is here, but I don't know. Can I see that in ratios? Maybe I can. I'm not going to take the time to look for it. What is it, like 1.5, maybe 2? I mean, they tend to be more on the 2s, and they have almost a 3 here. They're making on average around $2 billion per year in profits. I like that. You know, it's pretty cool. Anyways, so that's the stock. IO data. Unfortunately, no, you cannot buy a stock like this on Robinhood. I don't even think you could get it on TD Ameritrade. You need a broker that has foreign markets, and that's something like Interactive Brokers. It's one of the best things about why you want to have why you want to have money in Interactive Brokers. You get to expand into this market. I would feel very comfortable and a lot more comfortable going in a stock like this, especially the way the US market is now. The US market is just super delusional right now, and everything is super overpriced and high. So I feel a lot more comfortable being in this Japan market that's a little undervalued and everything's a little bit cheaper. I'm buying $1 for 60 cents in this case, and you know, I would feel comfortable if this stock fell all the way back to 2016 levels to $600. I would feel okay. I know it's worth $1,400. I have no problem. Now, what if we were wrong? Well, there's nothing wrong with that. If we were wrong, maybe it's like, let's just say we were wrong by half. And again, of this, I mean, it would be worth around what, 1,000 yen. I mean, you bought it at 784. It's decent. There's still a profit to be made. What is that? You can still make a 40% minimum. If you look at my 100K challenge, we've grown 6 times pretty much, and we haven't even taken a stock over 100%. I mean, it's just been compounding. So again, this is a great stock. I feel very comfortable, especially the way the market is. I mean, when one sector or one industry or one country is just super overvalued, it's a good idea to allocate some of that money into countries that are undervalued. And then within the undervalued countries, you want to buy undervalued stocks. This is a good example. Anyways, it was good talking to you guys. I will see you guys on the next video. I hope you learned something. For the algorithm, make sure to like, comment, and share. I mean, let me know you want me to keep making these videos. I don't really get that many viewers, which is completely fine as long as I help 1 or 2 of you. But you know, it'll help me stay motivated and like want to keep making more videos and upload more content for you guys and keep teaching you guys things. I mean, every time we do this, it's a different case study. You know, we're going to see different things there, here, and there. Real quick, by the way, we can go to the company's website. You can go to overview here and they have the website here. You can see more or less what they're selling. If you kind of want to look into that real quick. So this should be saved. So yeah, here's a little bit of what they have. Monitors, I mean chips, cables, speakers, CD thingies, modems for Wi-Fi, cameras, memory cards, CD, SanDisk, what is this, memories. It's a lot of electronics, you know, all this stuff you can sell. You can liquidate all this stuff. You can sell all this for 50% off. You could even go as far as 60%, 70% off. You can break everything down and sell everything individually. I mean, you have a huge margin of safety. Anyways, I'll see you guys on the next video.